Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts, and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video.
Welcome everybody, guys. Let's take a look again on the gold market. So this week on the gold market, it's only one headline for the whole week, is dedicated to the interest rates, especially on the background of the positive non-farm payroll release and the comments from the Jerome Powell. And it happens so that currently the fundamental background and its perspective looks more interesting and well, actually inspiring than a technical analysis. It's focused on the shorter-term perspective. From the fundamental point of view, well, actually, we have described everything in the weekly report, so you could read it. But in the two words speaking, currently it's a big concern around what is going on in interest rates. So even among the big whales, there is no agreement. So, for instance, the HSBC, UBS tells that Fed probably will have to act quicker and faster because the interest rates, nominal interest rates, are rising, inflation pressure is rising, and so on. While Goldman Sachs thinks that this will not happen as real interest rate stands flat, anemic, around the 0 point, no inflationary pressure stands in the market. And with the blurry perspective of the economy growth, there's probably no reasons to worry, no inflation hazard stands on the horizon. So it means that currently we have only one question: what's going on with the interest rates, with the nominal rate rising? So it means that if investors are trying to sell the good that is now exist, which I call some unreasonable interest rates jumping, it means that sooner rather than later it should fizzle. And it should return back and show some collapse on the market. Because they're trying to get the reward for the thing that actually doesn't deserve the reward. So they're trying to get the significantly higher interest rates to compensate an inflationary pressure that actually no exist right now. And it means that in the nearest time, I think that's somewhere in March and beginning of April, all this, let's call it as a bubble, should collapse. That's from the one point of view. But at the same time, if they are just anticipating of the rising inflation, it's coming ahead of the events that we have, well, that's quite another story. That means that despite any Fed comments or something, that sort of interest rates should keep growing. And this riddle probably should be resolved somewhere after the Fed meeting in the 16th and 17th of the March. So it's within the couple of weeks we should get the answer, because that will have the crucial moment for the gold as well. Personally, I'm gravitating to the idea of the major trend shifting, because this is not just the interesting rate rising. We have the background. We have the approximately 20% liquidity injections from the United States gross domestic product in the economy, and that's not over yet. So I'm not sure that we will not get any more. Second, we have the positive statistics across the board in consumption, employment, sentiment, everything shows the positive dynamic. With approximately 2% of the gross domestic product that stands on the accounts of the public as the savings, sooner with the improvement of the employment, with the recovery, with the vaccinations result, all this money will flow into consumption, at least the big part of it. And taking it all together, we can't ignore the really worries that stands among the investors that anticipate the inflation. Personally, I think that the economy is really reversing, and they are right with the pushing interest rates higher. So I think that tendency will continue. At the same time, in the short term, it doesn't mean that we will not see on the gold any pullbacks. They will happen. They have to happen, because we have the strong bullish momentum that lasts for a year on the gold market, even greater. And market actually stands at the first downside action from the top. Momentum hasn't disappeared, and it still will impact on the market. And from the technical point of view, here we have the very interesting combination of the different targets and levels. For instance, take a look on the gold market. Market is coming to the major 1650, 1680 rock hard support on the weekly chart. Interest rate stands in a very long-term resistance area. So we'll take a look at the weekly chart. You will see that 140, 150 is a long-term resistance that lasts for decades. So you could see. And still standing around. It's also 30% level. It's OP, by the way, of the same ABCD pattern. It's agreement. And also, theoretically, it should show some retracement because it's also first upward swing after long-term downside action. It's first bounce. It's suggested by technical analysis, the pullback. So, on the daily chart, you could see that we could get a kind of the, maybe it could be even some kind of a double repo here, if market will show the drop back below 140. Maybe under impact of the Fed comments, we do not know. But this scenario exists. And finally, on the dollar index, you all know about the 87.40 all-time long-term target that stands below the market, which suggests that dollar should fall a bit more before the major reversal starts. So putting it all together, it seems that something has to happen in a very short-term perspective, and the gold should get the chance on the bounce up from the support levels where it is going. But at the same time, we just can't not to see the bearishness of the market. So trend stands bearish in all time frames. Gold oversold on the weekly on the daily chart. But take a look what has happened with our butterfly. It was very small reaction. It's just no reaction actually on this target, the 1711. So the butterfly reaction actually was anemic. Now market's going lower. So the next target will be 1618, 1643. Which agrees with the weekly target. So it means that on the gold market, in the current situation, we ignore any bullish, in general bullish direction. We're not considering taking any long position until market will not reach the predefined level, 1640, 1650. That's the targets that market has to achieve before we again starts to think about the taking long position. And in general, this butterfly could become the pattern that will trigger the bounce on the gold, because we have the support on the weekly chart. It means that the patterns should appear on the daily, and the butterflies could become the first one that could become the background for a pullback up from this level. That's what we are waiting for. So it means that within the week, all the things that we could do is just to keep an eye on possible short-term scalp bearish setups on the intraday charts. That's for those of you who do not have any positions and think about whether to trade gold or not. Those who keep long-term bearish positions, no questions. You just keep the positions and wait the target will be hit. But for the others, well, currently I do not see something really special that we could trade. But since market is going to the target, we have this wedge pattern, we have the actually divergence on the market, but take a look, we do not have anything inside of the wedge. Here was the butterfly target, but also no reaction has followed. So all the things that we could do, just trying to catch some minor bearish continuation patterns. It's kind of the bread and butters, for example, after the drop, retracement taking the short position, downward continuation. Guideless triple twos, the same as here. ABC retracement up, taking the short position, some resistance with the downside action, and out at the previous low. So, for instance, let's suggest that we have some bearish stop here. You take in the short position and you should out on the previous lows, because market stands at the oversold on the weekly chart and on the daily. It is a bit dangerous to hold position longer, despite that commodities are more friendly to the oversold. They are not so feels uncomfortable compared to financial markets. They are not so sensitive, but still it would be better to out at the previous lows. So then just wait for another pattern. That's the only thing that theoretically we could try to do on the gold market if, in general, this strategy could look attractive at all. So the big really setups probably will be formed only around 1850, 1880 area when the 1650, 1680 area where the market will hit it. Until this will happen, well, it seems that some better trading steps you will find on the Forex market, on many other markets where you're trading. On the gold market, well, currently, I do not see that it's gives us something really fascinating for trading. So that's how we view on the gold.